Welcome to our brand new series, Crypto Trading Fundamentals. If you're coming from stocks, the rules are different, the markets are open 24/7, and the volatility is unlike anything else. Today, we cover the essentials, what makes crypto unique, and the three key terms you need to know. Important risk warning, crypto markets are highly volatile, unregulated, and subject to rapid, large price swings. Never invest more than you are prepared to lose. This is for entertainment and education only. Crypto's key difference, decentralization. Unlike stocks, which trade on centralized exchanges like the NYSE, cryptocurrencies operate on a decentralized network. This means no single government or bank controls the asset. This is important because it means markets are open 24 hours a day, 7 days a week. Your trading system has to adapt to never having a market close. Fundamental term 1, blockchain. At its heart, crypto is just a ledger. A blockchain is a public, digital ledger that records transactions across many computers, grouped into blocks that are secured using cryptography. This technology provides the transparency and security that defines the entire market. Fundamental term 2, market cap. This is how we measure the size of a cryptocurrency, just like a stock's market cap. Market cap equals total circulating supply current price. Why it matters for trading. Larger caps, like Bitcoin or Ethereum, are generally less volatile than smaller, low-cap altcoins. As a new trader, stick to the large-cap assets first. Fundamental term 3, exchanges. These are the platforms where you buy and sell. There are two main types. 1. Centralized exchanges, CEX. Think Coinbase or Binance. They are simple to use but require KYC, know your customer, and hold custody of your assets. 2. Decentralized exchanges, DEX. Think Uniswap or PancakeSwap. You trade peer-to-peer without an intermediary, and you retain full custody of your coins. This is more advanced but offers true decentralization. Trading adaptations, what changes? The technical analysis tools you learned, RSI, MACD, still work, but you must account for extreme volatility. Risk management is doubly important. Because the average daily movement can be 5% to 10%, you must use tighter position sizing and wider stop losses to account for the swings. The 1% rule is your best friend here. This is the most exciting and dynamic market in the world. Are you ready to dive deeper into the technical patterns that only exist in crypto? What is the first crypto asset you ever bought? Let us know in the comments. Subscribe to Weather Finance as we dive into spot versus derivatives trading next.